Welcome back to Money Made Simple. If you've been around this channel for a while, you know, one of my favorite things to do is read personal finance articles, especially anything related to retirement planning. And recently, I came across a headline that was way too clickable to ignore. Are you making this RMD mistake? 84% of retirees are. Credit where it's due. Whoever wrote that title knew exactly what they were doing. But it raises a bigger question. What mistake are they talking about, and is it actually a mistake? In this video, we're going to break down what the data says, what required minimum distributions RMDs really are, and the most important part, when taking only the minimum is smart and when it could backfire. What the study found. A recent study looked at how retirees are using their retirement accounts. And the results were surprising. 84% of retirees who were already at RMD age were withdrawing only the required minimum. And about 80% of retirees who were not yet at RMD age hadn't taken any distributions at all. Those numbers are higher than most people would expect, which is why this topic is worth discussing. But before we go deeper, let's quickly cover the basics, just in case RMDs are new to you. What is an RMD? RMD stands for Required Minimum Distribution. It is the minimum amount the IRS requires you to withdraw each year from certain tax-advantaged retirement accounts. Once you reach a specific age, most traditional retirement accounts are subject to RMDs, including 401k, 403b, 457b, TSP, Traditional IRA, SEP IRA, Simple IRA, profit-sharing plans. The big exception is Roth accounts, because of how they're taxed. Why Roth accounts are different? With Roth accounts, you contribute money you've already paid taxes on, so qualified withdrawals are typically tax-free. But with traditional accounts, you contributed pre-tax dollars, and your money grew tax-deferred. Eventually, the IRS wants its share. So at some point, the IRS basically says, you've had long enough. Now you must withdraw money so we can start collecting taxes. What age do RMDs start? RMD rules have changed in recent years. Under Secure 2.0, the RMD start age increased and is set to increase again in the future. So depending on your birth year, your RMD age may be higher than what older retirees used to follow. The penalty for missing an RMD. Here's the part you don't want to mess around with. If you don't take your RMD, the IRS can hit you with a penalty of 25% of the amount you were supposed to withdraw. That's a painful penalty. And even though that penalty may be reduced if you correct the mistake quickly, it's still a strong reason to make sure your RMD gets taken on time. Bottom line, if you have an RMD, you want to take it. How RMDs are calculated. RMDs are actually pretty simple to calculate. They're based on two things. Your account balance, typically as of December 31st of the prior year. Your IRS life expectancy factor. Based on your age, the basic formula looks like this. RMD equals prior year-end balance divided by life expectancy factor, and as you get older, that life expectancy factor goes down, meaning you're forced to withdraw a bigger percentage over time. Also, if you don't want to do this math manually, there are online RMD calculators that can estimate it quickly. So, is only taking the RMD a mistake? This is where the conversation gets interesting. Because taking only the RMD isn't automatically wrong. It depends on the reason behind it. Let's break down the most common reasons retirees only withdraw the minimum. Reason 1. Taxes. RMDs from traditional accounts are generally taxable income. So if a retiree withdraws more than the minimum, it can increase their taxable income, push them into a higher tax bracket, increase Medicare-related income costs, in some cases, trigger more tax on Social Security benefits, depending on total income. So for many retirees, taking only the RMD is a deliberate strategy to keep taxes lower. And when it's done intentionally, that can be a smart move. Reason 2. Wealth preservation mindset. For lifelong savers, retirement can be a tough shift mentally. Many people spend decades saving and investing, and then suddenly retirement arrives and the goal is to spend. But some people can't flip that switch. They stay stuck in the save for later mindset, even when retirement is the later they were saving for. There's also an important reality in retirement spending. For many retirees, expenses often decline over time. You'll hear it described like this: early retirement, go-go years, travel and activity; mid-retirement, slow-go years, less active; late retirement, no-go years, much lower spending. So if someone is using RMDs as a strict spending limit just to preserve their account balance, they may be missing the point. Money isn't only meant to be accumulated, it's meant to fund a life. Reason 3. They have other income sources. For many retirees, retirement income may come from multiple places: Social Security, a pension, cash savings, a brokerage account, dividends, or real estate income, Roth accounts. So if traditional retirement accounts are only one piece of the puzzle, it can make perfect sense to keep withdrawals low, especially to manage taxes. Reason 4. Legacy planning. Another big reason is legacy. Some retirees want their accounts to keep growing so they can leave more behind to family. And in some situations, heirs may even be in a lower tax bracket, which could reduce the total taxes paid over time. So again, taking only the RMD can be strategic. When it becomes a real mistake, here's the key takeaway: taking only the RMD is not always a mistake. It becomes a mistake when it becomes a limitation, when someone says, I'm only allowed to take the RMD amount, even if I could safely afford more, even if it would improve my retirement lifestyle. That's when it becomes a problem, because they may be shortchanging the retirement they worked so hard for. A good retirement withdrawal strategy should be based on your lifestyle goals, your total income picture, your tax plan, your long-term sustainability, and what you want your money to do for you. Wrap up plus call to action. So now I'm curious, are you already retired, and how do RMDs fit into your plan? Or are you still building wealth, and how do you think RMDs will affect your retirement strategy in the future? Drop your thoughts in the comments. And if you found this helpful, give it a like, subscribe to Money Made Simple, and share this video with someone who needs to understand RMDs before retirement. I'll see you in the next one.